Not trusting yourself as a strategy. Why strategic humility can improve investment outcomes. At first glance, not trusting yourself sounds like weakness. In investing, it can be a structural advantage. Overconfidence is one of the most persistent and costly biases in financial decision-making. Strategic self-doubt, when properly structured, can reduce error, protect capital, and improve long-term results. 1. Overconfidence is systematic. Behavioral research by Daniel Kahneman and Amos Tversky shows that individuals consistently overestimate their predictive ability, underestimate uncertainty, overweight confirming evidence. In financial markets, this leads to excessive trading, concentrated positions, ignoring risk signals, poor timing. Overconfidence increases activity, and activity increases friction and error. 2. Humility reduces trading frequency. Investors who distrust their short-term predictions are more likely to use passive or systematic strategies, diversify broadly, reduce discretionary trades, focus on long-term exposure. Less prediction, fewer impulsive actions, lower costs. As emphasized by John C. Bogle, founder of the Vanguard Group, accepting market uncertainty and minimizing unnecessary intervention often outperforms tactical brilliance. 3. Self-doubt encourages diversification. If you assume you might be wrong, you avoid concentrated bets. You hedge assumptions. You build margin of safety. Diversification is essentially an admission of uncertainty. Strategic humility strengthens portfolio robustness. 4. It reduces ego-driven decisions. Many poor investment decisions stem from ego. Refusing to sell a losing position. Doubling down to prove you're right. Holding because exiting feels like failure. If you distrust your initial conviction slightly, you are more willing to reevaluate, cut losses, adapt rationally. Self-doubt reduces attachment. 5. It protects against narrative bias. Humans are storytellers. When markets move, we build explanations that feel convincing, even when randomness plays a major role. Not fully trusting your interpretation slows reaction, increases verification, encourages rule-based behavior. It shifts decisions from narrative to structure. 6. It favors systems over impulse. Strategic self-doubt often leads investors to adopt automatic investing, rebalancing rules, allocation frameworks, predefined risk limits. This reduces reliance on emotional judgment. The decision shifts from, "I think this will happen," to, "I follow the system." 7. Historical evidence of humble discipline. Long-term investors such as Warren Buffett built success not on constant prediction, but on admitting uncertainty, demanding margin of safety, avoiding unnecessary complexity. Strategic humility does not eliminate conviction, it tempers it. Important distinction. Not trusting yourself does not mean lacking confidence, avoiding responsibility, being indecisive. It means recognizing cognitive limitations, respecting uncertainty, designing systems that compensate for human bias. It is structured skepticism, not insecurity. The psychological reframe. Overconfidence says, "I know what will happen." Strategic humility says, "I might be wrong. How do I protect against that?" The second approach builds resilience. Final insight. Markets are uncertain. Human judgment is imperfect. Investors who assume they are vulnerable to bias build safeguards. And often, the most profitable mindset is not extreme confidence, but disciplined humility. Because in investing, protecting against your own errors can be more valuable than predicting the future.